Welcome to the $0 to $1 million structural blueprint. This is your complete roadmap for building a scalable business from absolute nothing. The path from $0 to $1 million is not random. It follows a predictable pattern, and once you understand this pattern, you can replicate it across multiple ventures. Throughout this video, we're going to break down 5 distinct phases of growth, each with its own milestones, challenges, and tactical requirements. By the end, you'll have a mental framework that transforms chaos into clarity. Phase 1 is the validation phase. This is where everything starts. You have an idea, but ideas are worthless without proof. Your primary goal during this phase is to answer one fundamental question: does anyone actually want what you're building? Too many entrepreneurs skip this phase entirely. They assume their idea is brilliant and dive straight into building. This is a costly mistake. Instead, you need to get out and talk to potential customers. Spend time understanding their pain points. Listen more than you pitch. Create a simple prototype, or MVP, which stands for minimum viable product. This doesn't need to be perfect. It needs to be real enough to test your core assumption. During validation, your metric is not revenue. Your metric is customer feedback. Are people interested? Do they see the problem you're solving? Would they pay for a solution? You're looking for what we call product-market fit signals. Maybe you conduct 50 conversations. Maybe you get 10 people to pay you $50 each. That's $500, and it's infinitely more valuable than $0 because it proves demand exists. This phase typically lasts anywhere from 1 month to 6 months, depending on your market and how quickly you can reach potential customers. Phase 2 is the foundation phase. Once you've validated that people want your product, now you need to build something stable. Your goal is to reach your first $1,000 in revenue. This is a crucial threshold because it proves you can repeat your early success. 1 customer was luck. 5 customers is a trend. This phase is about systematizing what worked in phase 1. If customer conversations led to sales, now you're documenting your sales process. If you built an MVP, now you're improving it based on feedback. You're also establishing basic infrastructure. You might set up payment processing. You might create a simple website. You're building the bones of your operation. The foundation phase is mentally harder than validation because you're doing repetitive work at scale. You're not discovering anymore, you're executing. You might spend 3 months reaching $1,000 in revenue. Some founders do it in 6 weeks. The difference comes down to how well you understood your market during phase 1 and how aggressively you're willing to hustle. During this phase, you're still doing most things manually. You might be fulfilling orders by hand. You might be responding to every customer message personally. That's fine. You're optimizing for learning and validation, not efficiency. Phase 3 is the growth phase. This is where you're aiming to go from $1,000 to $50,000 in monthly recurring revenue, or $100,000 in total revenue if you're selling one-time products. The mindset shift here is significant. In the foundation phase, you were asking if you could do this. In the growth phase, you're asking how fast you can do this. You've proven the concept works. Now you need to scale. This is where you start hiring your first employees or contractors. We're automating the manual processes that were fine when you had 5 customers, but impossible when you have 50. During growth, you're also starting to think about unit economics. This is how much it costs you to acquire a customer and how much profit you make from each customer over their lifetime. If you're spending $10 to acquire a customer who pays you $100, that's a healthy ratio. If you're spending $50 to acquire that same customer, you need to improve your marketing or raise your prices. You're also starting to invest in marketing systems. Maybe you build an email list. Maybe you start running ads. Maybe you focus on content or partnerships. The key is finding repeatable channels that bring in customers at a profitable cost. Phase 4 is the scale phase. You're now aiming for $500,000 to $1 million in annual revenue. At this level, you can hire a real team. You have a salesperson, a customer success person, maybe a product developer. Your systems are documented. Your processes are repeatable. You're no longer the bottleneck for every decision. This is the phase where you start thinking about raising capital if your business model requires it. Investors become interested because you've proven the model works and you have the team to execute on growth. During scale, your focus shifts to efficiency and leverage. How can you do more with less? How can you automate further? How can your team members accomplish more per hour worked? You're tracking more sophisticated metrics now. You're looking at customer acquisition cost, lifetime value, churn rate, and retention. You're probably using project management tools, customer relationship management systems, and financial dashboards. You're making decisions based on data, not intuition. This phase can last anywhere from 12 to 36 months, depending on your market size and growth trajectory. Phase 5 is the optimization phase. You're at or approaching $1 million in annual revenue. You've built something real. You've created a team. You've established market presence. Now the question becomes sustainability and longevity. How do you build a business that can last indefinitely? This is where culture starts to matter. How do you attract and retain talented people? How do you maintain innovation while scaling operations? How do you expand your product line or enter new markets? During optimization, you're also thinking about profitability in a serious way. Early phases prioritize growth over profit. You might be operating at a loss or with minimal margins because you're reinvesting everything into growth. You're balancing growth with profitability. You're thinking about whether to stay independent or raise capital or eventually sell the business. You're thinking about your personal role. Do you want to run this business forever? Or are you building something to eventually hand off or exit? These are strategic questions that start mattering at this stage. Now let's talk about what runs through all 5 phases. First is customer obsession. Every decision, from day 1 through $1 million, should be driven by customer needs and feedback. Second is ruthless prioritization. You cannot do everything. You have limited time and resources. You need to focus on the activities that move the needle most directly. Third is speed. In the early phases especially, being fast beats being perfect. A good solution today beats a perfect solution 3 months from now. Fourth is data orientation. As you grow, decisions should be informed by numbers. What's working? What's not? Where are your bottlenecks? Fifth is resilience. Building a business to $1 million requires handling rejection, failure, and setback. You'll lose deals. You'll make mistakes. You'll have pivot moments. The companies that succeed are the ones that don't quit. One critical principle is understanding phase-specific work. In Phase 1, your work is talking to customers and validating. In Phase 2, your work is repeating what works and building infrastructure. In Phase 3, your work is optimizing the metrics and scaling channels. In Phase 4, your work is building systems and hiring great people. In Phase 5, your work is strategy and culture. Many entrepreneurs try to do Phase 5 work while still in Phase 1. They build sophisticated marketing funnels before proving anyone wants the product. They raise capital before validating the business model. This is backwards and wastes time and money. Another critical principle is the role of founder attention. Early on, your attention is the scarcest resource. Every minute matters. By Phase 5, your attention is still valuable, but you're delegating more and building systems so the business doesn't depend entirely on you. This shift from founder-dependent to system-dependent is what separates a job from a real business. If the business fails when you take 2 weeks off, it's not yet a real business. It's a job where you're your own employee. Let's talk about capital requirements across phases. Phase 1 requires very little capital. Maybe you spend a few $100s on tools and hosting. Phase 2 might require a few $1,000s to build your website and start paid advertising. Phase 3 might require $10,000 to $30,000 to hire your first contractor or employee. Phase 4 might require $50,000 to $200,000 depending on your model. Phase 5 might require capital raising or might be entirely bootstrapped if your business is already profitable. The beautiful thing about this framework is that you don't need to raise money to reach $1 million. Many businesses do it entirely bootstrapped. Finally, understand that every single business that's reached $1 million has gone through these 5 phases in roughly this order. The timeline varies, the specific tactics vary, the industry context varies, but the structural pattern is consistent. When you understand this pattern, you can stop comparing your timeline to others and instead focus on executing the phase you're in with excellence. You can also identify your phase and know exactly what kind of work you need to be doing. You can recruit people who are good at that specific phase. You can read content and get advice that's actually relevant to where you are. That's the power of this framework.